So I'm going to ask you this question for the last time. I promise I will never ask it again. How many of you have picked a company for your project? If your hand didn't go up, I don't even want to see you in terms of asking the question again. I'll assume you forgot to put your hand up. You have a company pick. Because we are close to a quarter of the way through the class. It's kind of strange to think that this early, but if you think in terms of marking time, we're in session 6. It's a 26 session class, so it's time to get the process moving. But before I forget, Monday is a holiday. I don't know, to be quite honest, I have no idea what you're supposed to do on President's Day. It used to be a big shopping day, but that's not it. But there's no school, right? And Wednesday, and this is important, we will not have in-person class. It'll be entirely a Zoom class. So I'll send you the link. The link is on Brightspace. So if you're planning an extended week and you don't want to come back physically on Wednesday, you can still watch the class online. Okay? So let's go back to where we were on the last session. We talked about, on Monday, we talked about how risk and return models in finance assume the marginal investor in your company, not every investor, not you or I, but the marginal investor is diversified. So I want to start today's class by delving deeper into who that marginal investor is and how for your company or any company you can decide whether the marginal investor is diversified. So let's say you take a company, and if it's a publicly traded company, it's a private company, we have an entirely different problem, right? Because there's only one owner, and this question might be answered even before you ask it. The owner is not diversified. We'll talk about what to do then. But if it's a publicly traded company, there are shareholders in the company. And if it's a big publicly traded company, there are potentially thousands, tens of thousands, even millions of shareholders. So here's the first thing you look at to decide who the marginal investor in your company is. And it's not a particular name, it's a type of investor you're looking for. Is that the type of investor? So if you're a company where the bulk of your stock is held by institutional investors, and insiders are a very small player in the game. There's very little shares held. It's a no-brainer. The marginal investor is an institutional investor. I would say if you take any older publicly traded company, which is a large company, anywhere in the world, this is going to be true, right? So if you take, for instance, Coca-Cola or Kraft Heinz, you might see a name pop up, but almost every name on the list is going to be an institutional investor. In fact, it's easy to find statistics like what percentage of your shares are held by institutions and insiders. I'll send you the links to do that. But if your company is one where 88% of the shares are held by institutions and there's really no insider holding, don't spend too much time on this question. Your marginal investor is an institutional investor. Here's a trickier one. What if you have a company where institutions own a high percentage, 70, 75, 80%, but insiders also own a high percentage? Many of the largest market cap companies in the world today are large tech companies. And many of these large tech companies have founders still part of the company.
Recording.
Sorry. Yeah. I'm sorry, what somebody from Zoom was, what was the question? Okay. What it was. So if you take a company like Facebook or Google, you have large institutional holders, but you also have large insider holders. Oracle, right? This company's been around a long time. Larry Ellison owns 25% of the shares. Is Larry Ellison the marginal investor? He's not, and here's why. When you have a founder, and this is true for family group companies as well, which own a large chunk of shares in the company, they own it for control. They can't afford to trade those shares. They'll give up control. And you can look at it. If their shareholding remains pretty stable over time, they might sell a few shares or a few thousand shares, even 1 million shares every year, just for tax purposes or to cover. But their holding is pretty stable. So here's the irony. If you're Larry Ellison, the people you have to keep happy for you to be happy are the institutional investors. Do you see why? Because if they are happy, they push up the price and the bulk of your wealth is tied. So in a strange way, if you're Mark Zuckerberg or you're Larry Ellison, you have to worry about what do institutional investors think about me. There's this delusion that if you're a founder-run company, you don't care what institutions are thinking. That is not true. You actually care more because all your wealth is tied up in the company. You know how much money Mark Zuckerberg lost 3 weeks ago when the earnings report came out? I mean, probably 20% of whatever his holding was $60 billion. That's $12 billion gone in one day. Can you imagine waking up and saying, oh my God, I've lost $12 billion. None of us, I think, I don't want to insult you, maybe you'll be the next Mark Zuckerberg, is going to wake up to that kind of recognition. So if you have a company where institutions hold a lot, and there's an individual or individuals holding shares, still the institutional investor who's the marginal investor. If you have a company where institutional investment is low and insiders own a big chunk of the company, then it gets trickier because you have to ask who are the insiders. I mean, India has thousands of publicly traded companies. Many of them have no business being publicly traded. And here's why. 97% of the shares are actually held by a founder owner. 3% are listed. You think, why bother? Because they want to get a market price. These are really private companies where the founder is running the company and he uses the market to get a price. Those companies, the marginal investor is definitely not an institution. It will be the founder. And we have to come back and ask what then? Because that founder might not be, or in fact, probably is not diversified. It's like a private business. Here's a trickier one. You have a company where institutions hold a low percentage, but a wealthy individual owns a lot of shares, but that wealthy individual owns it as part of a portfolio. You've heard of Paul Allen? Paul Allen co-founded Microsoft with Bill Gates. But about 10 years in, he decided to cash out. He cashed out his shares. And then he had a lot of money and he created basically a portfolio. In fact, there used to be a group of people who ran his money. And this is true across the world. There are family group companies that manage family wealth, investing in bunches of companies. Those are like institutional investors. They might not call themselves institutional. So if that is your big investor, is somebody like a Paul Allen, you can say, you know what? It's not an institution, but it's institution-like because they're diversified. Clearly, the dividing line for you is the investor in my company diversified or not diversified? And finally, there are a few companies where neither insiders nor institutions own very many shares. They're saying, who's left? Retail investors, individual investors. if you run GameStop, I don't know who your investors are, to be quite honest. You might have the most insane group of people on the face of the earth holding your shares. Are they diversified? Do you think a typical trader who buys games, I know if they're diversified, they own GameStop, AMC, and Bitcoin. It's a very strange definition of it. So all bets are off because it then depends on who the individual investor is. So when you remember, we looked at the list of shareholders to see where the power lay. Take a look at another list to ask a different question. Is the marginal investor in my company likely to be diversified? Because that question is critical to accepting any of the answers you get from risk and return models in finance. So let's say you've made that assessment. Your investors are diversified. You're on safe ground now. Let's take a look at Disney again. Remember I showed you Disney in 2003? There was nobody on the list. 2009, Steve Jobs. This is 2013. Steve Jobs had passed on, but his shares are held by Lorraine Jobs. She's now the largest shareholder in Disney. That's still true. But notice somebody else has popped up on the list that wasn't there in 2009. How the heck did George Lucas make it here? Because when Disney bought Star Wars, they paid in shares. You can see that shareholdings can change over time. Keep your eye. So if you have your shareholding for your company right now, it might be interesting to go back and look at what it looked like 5 years ago, 10 years ago to see if it's shifting. GameStop, it's definitely shifted. 5 years ago, it was just a small market cap company held by institutions. It was a no-brainer institutional. Today, I think the shareholder base is very different. Now, for my other companies, it wasn't as much of a slam dunk. With Disney, I looked at this list and I said, you know what? Lorraine Jobs owns a lot of shares, but she doesn't trade them. How do you know? You look at 2009 and 2013, the shareholding has remained pretty stable. George Lucas owns a lot of shares. He was pretty pissed off with how Disney made the Star Wars follow-up movies, but not pissed off enough to pay off a lot of taxes. So he complained, he bitched and he moaned, but he kept the money, which always strikes me as hypocrisy, right? Remember those WhatsApp owners complaining about what Facebook was doing to WhatsApp? Well, you took the $17 billion that Facebook paid you and you kept it. If you really want, if you feel remorse, maybe you should return the 17 billion and then complain. Until then, you can complain as much as you want, but I'm not listening. So if you look at this list, you ask me who's the marginal investor in Disney. I'm not going to say it's BlackRock. I'm going to say it's a big institutional investor because it doesn't matter to me whether it's BlackRock or Fidelity or State Street. They're all diversified. And why it matters to me is the risk that they then see in Disney is the risk that you cannot diversify away. So don't look for a name, look for a type of investor because the names will keep shifting on you. Institutions buy and sell. And that investor, if that investor is diversified, you're on safe ground when it comes to risk and return models in finance. Now, for my other companies, it wasn't as much of a slam dunk. If you look at Deutsche and Vale and Tata Motors and Baidu, the distribution of institutional investing is all over the place, right? Especially if you look at Deutsche, much lower institutional holding, much bigger individual holding. A lot of German individuals often have Deutsche shares in their portfolio, often as legacy shareholdings that they were left by 30 years ago. They're probably regretting every moment of holding it for the last 30 years. But basically, you can see the institutional investing varies. But I think for each of these companies, if you dig a little deeper, even for Tata Motors, where you have the family group with those cross holdings owning shares, I think the marginal investor is the institutional investor. Maybe not as much certitude as I did for Disney. Tata Motors share price is not being set by the Tata family telling you what they think about the shares. It's being set by institutional investors. The interesting side question is domestic institutional investors or foreign institutional investors, right? It used to be 30 years ago, if you're Tata Motors, your institutional investors were all Indian mutual funds. Today, you have a much bigger chunk of foreign institutional investing. We'll see why that matters when we talk about betas and the way you perceive risk. But I think for all of my companies, my marginal investor is institutional, it's diversified, I'm okay. I've listed 5 here. Remember, there were 6 companies I was looking at. The 6th one was not a company, it's a privately owned bookstore in New York City. Do you think that owner is going to be diversified? Do any of you have relatives who run their own businesses, maybe a family business? If you run a family business, you know where your wealth is tied up, right? Every dollar you have usually goes back in the business because you have no choice. Private business owners are the exact opposite of diversified. And you know what that means? None of the risk and return models in finance can be applied without adjusting the models for that risk. So we'll come back and talk for Bookscape, how we're going to adapt the model. But for the publicly traded companies, I'm going to argue that we're on safe ground using the risk and return models in finance. Any questions? Yes.
Should we look at company level or security level? So for example, Discovery has 3 types of shares. The composition is different depending on where you're looking at.
I think it has to be at the company level, right? Because ultimately, now you got to trace back. I'll give you an example. Let's suppose you have a company whose largest single investor is another company, right? It sometimes happens. That company doesn't have any money to invest. It's investing that company's shareholder money. So ultimately, sometimes when you have companies where you have the bottom of the pyramid, and that's the company you're looking at, you got to trace your way back to the top of the pyramid to see who the shareholders in that parent company are, because that's what drives how you think about risk. So at this point, we made an argument that diversification is sensible for most people. It's almost a slam dunk argument, but this weekly puzzle really looks at people who contest it. Quite a few people argue you should concentrate rather than diversify. I don't buy the concentration argument, but I also told you that I have about 50 companies in my portfolio, but I have only 50 companies. You're saying, what do you mean only 50 companies? There are 46,000 publicly traded companies in the world. I stopped at 50. So I have a question. Why did I stop at 50? Give me the cruel answer first. You don't have enough money. True. I'm not a multi-billionaire. I can't go buy 500 companies, so I ran out of money. So that's the first reason I stopped. What's the second reason? And even if you don't have enough money, why can't you keep buying? What is it? What's the trade-off you're looking at? Every additional stock gives you benefits. The benefit gets smaller, but it's still there. Even the 15,000 stock. So the marginal benefits get smaller, but they never disappear. So what am I weighing the marginal benefit off against? Well, let's put the due diligence aside. Even if that's not the issue, there is the transaction cost, right? This time, of course, I could go on Robinhood and you think there's no cost. That's not true, right? The brokerage cost might be 0, but there's a bid-ask spread and the price. So collectively, there's a transactions cost that says, okay, at this point, I'm stopping. The other reason, and this might be delusion, is you think you can pick the right companies. I mean, who wants to be an average investor? Who wants to have an average kid? My wife and my daughter teach in schools and they have teacher conferences and no parent comes and my kid is average. Everybody's above average, which makes it difficult. What exactly is the average if everybody's above average? But we leave that for another day. No investor wants to be an average investor. We all want to beat the market. And better or worse, many of us try, right? We try to be like Warren Buffett. We try to follow Jim Cramer. We do whatever we need to. So due diligence might be too strong a word, but we think we can pick stocks. So the 2 reasons we stop are transactions costs, and we think we can pick stocks. And it's not just me, Fidelity, which has enough money to buy every stock. Now, if you look at Fidelity Magellan, stops at 150 stocks because that manager thinks that those are the best growth stocks to invest in. Now, I'm not going to debate that notion, can you pick stocks? But real or not, those are the 2 reasons we stop. Now, let me go back to the CAPM. We talked about how CAPM measures risk as variance. We talked about how the CAPM assumes investors are diversified. It makes 2 other assumptions. The first is there are no transactions costs. The second is there's no private information, which is a euphemism for you can't pick stocks. If there's no transactions cost and I cannot pick stocks, when should I stop? I get to the 50th stock, I should still go 51, 52. In fact, I should include every publicly traded stock and then keep going, right? Every publicly traded bond, every publicly traded piece of real estate. By the time I'm done, I should have a little piece of every single traded asset in the market. You think that's absurd? It's a logical end product of having no transactions cost, and you can't pick the best investments. So I have this portfolio that includes every single traded asset in the market in proportion to its market value. What should we call this portfolio? Let's be creative. Let's call it the market portfolio. How amazing. That's a creative name we came up with. The market portfolio includes every single traded asset in the market. And if we lived in the CAPM world, let's say this is the entire world of investors, each of us would end up owning exactly that portfolio. It's not that outlandish. Think of it as a gigantic index fund that owns, you could create one, right? Vanguard is this total market fund. In fact, there's index funds for stocks and bonds. Think of it as one big index fund, and we're all holding that same fund. And therein lies a puzzle, because not all of us feel equally comfortable taking risk, right? And I'm telling you, hey, you all own the same fund. You're saying, how do we differentiate then as individuals that some people might want to take very little risk, some might want to take more risk, and some might want to take an extraordinary amount of risk? Let's say in the CAPM world, how we adjust for investor risk preferences. Let's assume you want to take no risk, right? There is a market portfolio, the index, and I'm going to introduce another choice. There's a way in which you can invest risklessly. We can call it treasuries or whatever you want to call it. If you want to take no risk, what will you do? You put all your money in treasuries. You want to take some risk, you might put half your money in the market portfolio, half in treasuries. Let's say you want to take even more. You put all your money in the index. But if you want to take even more, how do you get past 100%? In the CAPM, what do you do to take on more risk? You know, he's already invested all his money. You want to take even more risk. What's the most efficient way of taking risk? Anybody? Yeah. You borrow money, and guess what he invested? The same market portfolio. The reason is it's the most efficient way in this world of taking risk. And the way you see differences then is what percentage of your money you put in the riskless asset and what you put into the market portfolio. It's a mind-blowing conclusion, because it basically means we all hold the market portfolio, which means if I come to you with a stock, it could be Disney. It could be GameStop. You know how you measure risk? You measure the risk it adds to the market portfolio. We're almost there. We no longer think of risk in a company as risk standing alone. We think of it as a risk added on to the market portfolio. And statistically, the way we measure that risk is we look at how the stock you're looking at moves with the market portfolio. Let me cut to the chase. If you picked a stock that has no co-movement with the market portfolio, it moves, but it moves on its own. You know how much risk it would add if you add it to your portfolio? No risk at all, because it's completely uncorrelated. If your stock moves with the market portfolio, not perfectly, but most of the time, then you're more exposed to risk. In statistics, that's measured with what's called the covariance. In the CAPM, the risk in a stock is measured by its covariance with the market portfolio. I know we're in statistical wildlands now. Let's keep going, though. If I told you the covariance of Disney with the market portfolio is 26%, you know the problem with the covariance measures? What do we say? One of the qualities we look for in a good risk and return model is if I give you the number, you should be able to say that's high, that's low. The 26% is neither here nor there, right? So here's the final step. I'm going to take the covariance of Disney with the market portfolio, the covariance of every stock with the market portfolio, and I'm going to divide each of these covariances by the variance of the entire market. Covariance divided by the variance of market is beta. We picked up a lot of luggage getting here, but whenever you use beta, remember all of these assumptions we made to get here. Because in this world, beta measures the risk of a stock because investors are diversified, but all those is no transactions cost, no private information. And the final step is if beta is the measure of risk, I can convert to a hurdle rate by starting with a risk-free rate, because I'm not going to settle for less than that. The beta becomes a measure of risk. So it's a relative risk measure. It's scaled around 1. And then ask, what would I make on an investment of average risk? That's called the equity risk premium. Think of it as what you collectively make across risky assets. The risk-free rate, the beta, the equity risk premium. The CAPM came out in the early 60s, 1963, 64. Bill Sharp and John Lintner, who developed the CAPM, Bill Sharp ended up winning a Nobel Prize for it. Because it was clever, right? Basically, it said, look, I don't have to judge the risk of a stock by looking at it standing alone. All you have to do is look at how it moves with the market portfolio. But the model over the last 60 years, there's quite a lot of people who don't like it. In fact, there are probably more people who dislike the CAPM than any other finance model that's ever been come up with. And I'll give you, broadly speaking, the 3 critiques of the CAPM. The first is it makes unrealistic assumptions. Does it? Absolutely. No private information, no transactions cost. All we care about is variance at each step. In fact, we were pretty open about this, right? You know what? That critique doesn't bother me in the least. And here's why. In a previous life, I started life as an econ major. I very quickly switched. Because remember all those econ classes where people made realistic assumptions and ended up with models that nobody could use. I still remember this econ class where the professor went through a utility-based model for coming up with expected returns. I said, that's very neat. But how do we observe utility-based models? Because you need to get that U double prime W to be able to use the model. And he said, nobody's ever been able to see a utility model yet, but if you see it, everything will be clear. I said, thank you. Given a choice between making realistic assumptions and having models you cannot use, and making assumptions that kind of simplify reality and ending up with models you can use, I'll take the latter over the former. The second critique is the critique of the coward. He listened to this and he put up his hand or her hand and said, you know what? A lot of estimates in this model. You could be wrong. You could be wrong about the beta. You could be wrong about the equity risk premium. You might even be wrong about the risk-free rate. To which my response is, you think that's all I'm wrong about? You should see my earnings numbers, my cash flow numbers, my margin numbers. You're going to be wrong on every single input. You know why? Because you're trying to forecast the future. If your test of a model is, I will not use it until you can prove to me that the inputs are right, you will never use a model. So that I can live with too. It's a third critique that cuts to the bone. Remember I said a good model, if you use it, should be a good predictor of what your returns are. Not over short periods, but over very long periods. So if the CAPM is the right model for risk, here's what you should expect to see over very long periods. Stocks with high betas should earn high returns. Stocks with low betas should earn low returns. And it goes beyond that. Once I use betas to explain returns, nothing else should matter. I can throw in earnings and growth rates. It should all be irrelevant. It should be priced in. So that's a testable proposition, right? So after the CAPM came out, people tried to test it. And they discovered that it didn't work that well. In fact, it culminated in a paper written by 2 professors who were then at the University of Chicago, Gene Farmer and Ken French, one of the most famous papers in finance, where they asked a very simple empirical question. If we take 30 years of data and we look at the differences in returns across stocks, what percentage of those differences over that very long period are explained by betas? And if the CAPM is the right model, what should the answer be? It should be a very high percent, 90%. You know what the answer they came up with was? 7%. 7% of the variation returns over very long periods is explained by difference betas. Or that's a kind way of putting it. Basically, a much more harsh way of putting it is we're using a model that doesn't explain 93% of the variations in returns across stocks. I'll talk about why the model actually does so badly. I think part of the reason is the way in which we're taught to estimate betas is completely screwed up. But even if you estimated betas correctly, I'll take their point. Betas don't explain 90%. They're closer to 20%, even with good betas. And that then raises a question of what to do next. So for 50 years in finance, people have been trying to come up with a better model to explain returns because the CAPM doesn't work that well. So I'll take you through a very quick journey on the alternatives to the CAPM. In the 1970s, professor at Yale, Steve Ross, said, you know what? Why are we trying to come up with this beta model? Let's think about it broadly, that the only risk that matters is the risk you cannot diversify away. But let's accept that that risk can come from multiple sources. Why are we trying to consolidate all in one beta? Because in the CAPM, we're trying to capture all of that one. So he said, let's allow for multiple sources of market risk and estimate the beta against each one. Sounds reasonable, right? And when he came up with it, people said, that's nice, but how will we know how many sources of market risk there are and what the betas are? He said, that's very easy. You give me 50 years of daily returns on stocks, and I should be able to tell you, and here's why. What's the definition of market risk? Most or many companies move together because of it, right? So he put the computer in a search mission. It's called a factor analysis. He said, go through the data looking for patterns. Are the same 550 or 600 stocks going up or down? And detect what those patterns are. How many patterns are there? So those are called factors. And what are the loadings on the factors, which are betas? It's a purely statistical analysis. It's called the arbitrage pricing model. Came out in the 1970s. When it came out, people thought it was a godsend. This could now replace the CAPM, much more general model, 5 different factors. It never caught on. And to see why, let's suppose you're a company. Remember, this is what used to come up with a hurdle rate for you, right? You used to use the CAPM. You put in a beta, risk-free rate, you came up with 15%. I now show up and say, hey, you should switch to the arbitrage pricing model. And you're willing to listen because it sounds sophisticated. I say, based on the arbitrage pricing model, your cost of equity should be 18%. Now, you're not going to take this lying down. So why is it so high? And I'll tell you. It's because you're very sensitive to the second factor. What's your question going to be? What the heck is the second factor, right? To which my response is, I don't know what it is, but be very careful when it's around. You see the problem with the arbitrage pricing model? The factors are statistical factors. They don't have names. Nobody's going to switch to a model where if you can't tell them why is your beta high against the second factor, if you don't know what the second factor is. So there's a fix for this, right? So the arbitrage pricing model didn't work because you couldn't name the factors. What's an easy fix? Try to come up with names for the factors. And they can't be random. You can't just say, let me pick a name. But when you do a factor analysis, you actually get a chart of each factor over time. For the next 6 or 7 years, people spend millions of dollars and dozens of papers trying to find the macro, because you knew it had to be a macroeconomic factor, right? It applied across companies. And they were able to put names on the factors based on past data. When you put names on these big factors, it's called a multi-factor model generically. But when they finally named the factors, I think the first thing that showed up, like the early 1980s, they came up with things like the term structure of interest rates. Basically, each one had a name: level of rates, term structure of rates, GDP growth. So finally, they get their I's dotted, their T's crossed, they've got names. I come up to you and I say, you know what? We have a new model. It's called a multi-factor model. We plug the numbers in for your company, and we've come up with a 19% cost of equity. You ask me the question, why is it so high? I said, because you're very sensitive to the third factor. But now I'm ready for your question. fact, if you don't ask me the question, I'll ask it myself. What's the third factor? No, it's oil prices. And you say, what Pepsi? What do we have to do with oil prices? We don't use oil in our drinks, even though it might taste like we do. You know what happened? I fit the factors based on past data, right? In the early 80s, what is the most recent decade? The 1970s. Oil prices were a huge factor driving stock prices. I have a model that really fits the past, but by the time you get to the early 80s, oil prices had ceased to be a major factor in stock prices. The problem with multi-factor models is the factors keep shifting on you. What mattered in the last 50 years might not matter for the next 50. They're great models for explaining the past, but terrible models to explain the future. So the arbitrage pricing model tried, didn't get anywhere. Multi-factor model tried, didn't get very far. Finally, in 91, the Farmer French paper said, why are we even trying to build a model? All we need is something that will tell you what kinds of companies earn high returns and what kinds of companies earn low returns, right? Those low returns are basically low cost of it. So they went back and looked at the data. And they said, we're not going to fit a model. We're just going to see what explains the past. And now you open the door for anything that works, they threw it. Have you ever done kitchen sink regressions? You try this and you try that, or the R squared went up. They did it in a more sophisticated way, but when the time they were done, they came up with the variables that best explain past returns. And I'll give you the two variables they found in the early 90s that best explain stock returns. One was the market cap for your company. Small market cap companies seem to earn higher returns than large market cap companies. And then they made a leap of faith. They said, if small market cap companies earn higher returns than large, they must be riskier. Do you see why that's a leap of faith? Because you're assuming that markets must be right in the long term, and that if you get a higher return, it must be because it's riskier. They also found that stocks that trade at low price to book ratios. You know what a price to book ratio is? The price, of course, is what the market thinks your equity is worth. The book value is what the accountant thinks your equity is worth. Companies that traded at low price to book ratios earn higher returns than companies with high price to book ratios. So they said that must mean if you're a low price to book company, you must be riskier. In fact, the way they ended up with the regression equation where they said, you tell me what your market cap is and what your price to book is, and we plug it into the regression, we'll come up with the cost of equity for you. It's a very karmic model, and here's why. If you're a small company with a low price to book, you're going to end up with a high cost of equity. You can complain to me that you're safe and that your earnings are predictable. I said, tough. The market has already spoken. These models are called proxy models for risk. Because in a sense, you've given up on a model to measure risk. You're letting something else stand in. Every risk and return model in finance is somewhere in that page. But if you walk into a consulting firm or an investment bank or an appraisal firm, guess which model is still standing? It's still the CAPM. And it's not because of not trying, right? We've tried to replace it, but nothing seems to stick. So that's a big puzzle. CAPM is like Freddy Krueger. Every Halloween you kill it, next Halloween it's back again. What gives this model the life that it has? To understand why the CAPM endures, I'm going to tell you a story. It's about these two campers up in the mountain somewhere. It's late at night. They're sitting around a campfire when they hear the sound of a crazed grizzly coming at them through the forest. Now, don't nitpick and tell me grizzlies don't go crazy, but let's assume it's a crazed grizzly. They can hear, sounds, screams, squeals, things being, So one of the campers gets into a sleeping bag, zips up, and gets ready to die. The other guy starts jogging in place, warming up. The guy in the sleeping bag says, "What are you doing?" He says, "I'm going to run." The guy in the sleeping bag said, "Don't be crazy. You can't outrun a grizzly. They run 50, 60 miles an hour when they're crazed." The guy who's warming up says, "Look, I don't have to outrun the grizzly. All I have to do is outrun you." It's a morbid thought, but think about that. If you measure the CAPM against perfection, it falls, it falls short spectacularly. But remember what Milton Friedman once said. He said, it takes a model to beat a model. And when you look at the alternatives, here's the sad conclusion. They're all just as crappy as the CAPM at best. And if you have a choice between 3 crappy models, and one requires you to estimate only one number, and the other requires you to estimate 5 numbers, which one should you pick? I would pick the one number. Why would I go estimate 5 betas in a multi-factor model to screw up when I can do the same kind of screw up with 1 beta? I know this is as weak a defense you've heard for a model as there is. But I'm not going to stand here and say the CAPM is perfect. It's not even close, but it's the best of what we have. And I'll be quite honest. We get better data, we build better models. Even in our best case scenario, the model we build will not explain more than 25% of the variation returns. You know why? There are 60 million people walking around thinking Elvis is still alive. Think of all those people who are playing GameStop and AMC games. How can you build a model that explains away all those behavioral factors? They're random. You can't build them into a model. So one of the first things I'd like you to do before you delve in and start estimating things is stop and ask a question about your company. Who is the marginal investor in your company? Remember, you're not looking for a name, you're looking for a type of investor. If that investor is likely to be diversified, heave a sigh of relief and move forward, because that means you can pick any of these models and you're going to be okay. But if that's not true, you might have a bit of a problem. It's not an insolvable problem because I've got to come and deal with it when I do Bookscape. But you might have to think about a different way of bringing risk into your hurdle rate if you have a company that looks more like a private company than a public company. So now let's go past these abstractions. No, so at this point, I'm completely agnostic about which model you take, CAPM, arbitrage pricing model, multi-factor model, because every one of these models, you need 3 inputs. You need a risk-free rate for every model, right? You need a beta or betas for every model. If you have only the CAPM, 1 beta. If you have a multi-factor model, 5 betas. And you need an equity risk premium. The CAPM, 1 equity risk premium. And in a multi-factor model, risk premiums in each of the factors. I want to get practical because I don't want to spend any more time talking about theory. I'm done. Let's start by looking at these 3 inputs. Of these 3 inputs, which should be the simplest? Let's start simple. The risk-free rate. In fact, when I did my MBA, which was a lifetime ago, 1979 through 81, you know how much time we spent on the risk-free rate through the 2 years? 30 seconds. Because here's what I was told. Use the US Treasury rate as a risk-free rate. Let's move on. Shows you how dollar-centric my MBA class was, and also how much trust there was. If you had the Treasury rate, you had the risk-free rate. The risk-free rate has become a little messy. So I'm going to start and spend some time on the risk-free rate. And I'm going to start by giving you my definition of what makes for something that's risk-free. On a risk-free investment, you need to know exactly what you will make with certainty. Remember the example I gave you when I started the CAPM? I gave you the T-bill rate. And I said it's risk-free because you have a time horizon that matches. So let me add to this definition. For something to be risk-free, 2 conditions have to be met. The first is the entity issuing the security can have no default risk, not even a tiny bit. And the second is your time horizon has to match up to whatever. So already you can see that risk-free rates will vary across currencies and risk-free rates will vary across time. A 1-year risk-free rate will not be the same as a 5-year risk-free rate as a 10-year risk-free rate. So I'll give you how a purist would estimate risk-free rates. And I'm not a purist. I'm going to tell you up front that I've never done this. I'm not even tempted to do it. If you're a purist, the way you would estimate a risk-free rate is you would take each cash flow. So let's say you have a capital budgeting project. You have 10 years of cash flows, cash flow in year 1, cash flow in year 2. You take the first year's cash flow and you'd come up with a risk-free rate for the first year. It's got to be default free and time matched. So you're doing things in dollars. You say, for the 1 year cash flow, I'm going to use the 1 year T-bill rate. For the 2 year cash flow, you can't use the 1 year rate anymore. You might use the 2 year rate, but now you have a little bit of a problem. The 2 year rate comes with a coupon, and that coupon has to be reinvested, and you don't know at what rate. So here's what you do. You take the coupon out and you make it a 0 coupon 2 year rate. So in a purist world, every cash flow would have a 0 coupon rate from a default free end. Think of the nightmare I've created, right? You can't use the PV function in Excel anymore because each cash flow will have its own discount rate. And why? Because I'm building in year-specific rates. I don't have the patience for that, and I don't think it makes much of a difference. What if instead of using a rate that matches each cash flow, I did what banks used to do 30, 40 years ago to manage the balance sheets? Banks have interest rate risk. Every liability has an interest rate. And in a perfect world, what you do is you match each asset with the duration of it. So you have 100, each one would have a liability that's exactly matched up. Banks can't do that. So what they would do is they take a weighted average of the durations of their assets and check it against a weighted average duration of their liabilities. They said, look, we're close enough. It's not perfect, but we'll take it. I'm going to use the same process. Remember I said you had 10 years of cash flows in your capital budgeting? The cash flows are different in every year, obviously. I'm going to ask you on a weighted basis, what's the duration of this project? So if it's rear end, the cash flows are all towards the end, it might be 7 or 8 years. If they're more spread out, it might be 5 years. And then I'm going to go look for a risk-free rate with roughly the same duration. You're saying, what does that mean, duration? Let's say your project has a 7-year duration. A 7-year regular bond is not going to have a duration of 7 years. It's going to have a duration of like 5 years. You know what duration is, right? A weighted average of when the cash flows come in the bond. I'm going to take a 10-year bond. A 10-year bond is going to, so it's rough, it's approximate, but it works. In fact, rather than keep going down this road, I'm going to save you the trouble. In corporate finance, almost everything you do is long-term. You should be using a long-term default free rate. We can debate whether it should be 10 or 30 years, but you should never be using a T-bill rate. In corporate finance, it just doesn't make sense. So let me build on that, because I've talked about the treasury, the T-bond rate is the risk-free rate. That works if I'm doing everything in US dollars. But some of you have companies that are European companies or Indian companies or Brazilian companies. You're working with currencies that are not the dollar. You need a risk-free rate in that currency. So you're saying that's easy. I'm doing a Brazilian real valuation. I'll go look up the Brazilian real government bond rate. Yes, you can do that. But you're going to run into a bit of a problem. The Brazilian government has default risk even on its local currency bonds. You're saying, why? Why can't they just print the money? They could, but they choose not to. And we know this because half of all the sovereign defaults in the last 50 years have been local currency defaults. So this advice you're given, and it's given in many classes, just use the government bond rate as the risk-free rate, is going to fail you miserably if you're doing evaluation in Nigerian Naira or Brazilian Reais. Forget about the Venezuelan Bolivar, we don't go there. But basically you can see the government bond rate is not your risk-free rate. So let's start easy. Let's assume that you have a currency where there's at least one government that is default free, issuing bonds in that currency. You're home, you just take the government bond rate and you're done. Notice how I said one government which is default free. See, what do you mean one government? You can have only one government issuing bonds in a currency. Not true. Let's say you're doing an analysis in euros. In November of 2013, if you asked me what the government bond rate was in euros, I'd have given you 10 different countries, all of which had government bonds, 10-year bonds denominated in euros, and the rates are all different. So given what I just said about you want to find a default free entity, which of these rates would you use as your risk-free rate in euros? Want to try? Yeah. And the reason for the German? You don't even, it's just the lowest. That's all you need, right? Don't go any other. Don't say it is because it's German and they manage their economy. This has nothing to, you don't have to pass any value judgments. If 5 years from now, the Greek 10-year euro bond is the lowest, miracles can happen. I'd be using the Greek bond. This is nothing to do with German. It's got to do with the fact that if it's the lowest, it's the one that has at least a chance. I mean, there are people argue that even the German 10-year bond has some default risk, right? The problem when you went to the euro is you can no longer print currency freely. There's actually an ECB 10-year bond, European Central Bank bond. The rate is almost exactly the German bond rate. So if you're doing your analysis in euros, just use the German 10-year bond rate. You're saying, what if I have a Greek company? I know you want to punish this company for being Greek, but the risk-free rate is not the place to do it. Don't make the risk-free rate a bludgeon to punish companies because they have country risk, because it's risk-free. I value a Russian company in US dollars. I'm going to use the T-bond rate as my risk-free rate. There's another place in this calculation to bring in country risk, and the risk-free rate ain't it. So this graph, what I did was I took the easy countries. These are all countries that at least in November of 2013. You're saying, why are you going back to November? Because many of my numbers for the companies, my lab experiment companies, were in November of 2013. I'll give you the updated risk-free rates today. November of 2013, these were all the AAA rated countries. So in a sense, I'm trusting ratings agencies to tell me which countries have no default. That's a dangerous thing to do, but it takes a lot of work off my plate. So these are the risk-free rates in Japanese yen, Swiss francs, euros, Danish krone, all the way to Australian dollars. Notice they're all risk-free and they're different. There's no such thing as a global risk-free rate. It's an absurd statement. Risk-free rates go with currencies, and each currency carries its own risk-free rate. We'll talk about why in a second, but that's, before we do that, I want to now talk about the currencies where it's difficult to get a risk-free rate. Remember I said, if you have a default-free entity, even one, like the euro, I can get a risk-free rate. But there are some currencies where there's only one government that issues bonds in that currency, and there's default risk in that government. Let's take an example. Now, one of the companies in my list is Tata Motors, where I need a risk-free rate in rupees in November of 2013. In November of 2013, the 10-year Indian government bond rate in rupees was 8.82%. So let me pause right there. Many people use that as a risk-free rate, but I think it's a mistake because that 8.82% has a default risk in it. If I could somehow tell you how much of that 8.82% was default risk, I could clean it up, right? Give you a risk-free rate. And here again, I'm going to cheat and let the ratings agency help me out here. In November of 2013, India's currency rate and local currency ratings agencies, sovereign ratings agencies give you 2 ratings for every country. A foreign currency rating, which is the risk they see when you borrow in a foreign currency, and a local currency rating. I'm focusing on the local currency rating because that's a rupee rating, Baa3. Not a bad rating, but definitely not AAA, right? In 2013, the default spread on a Baa3 rated country bond was about 2.25%. We pause right there. There's my government bond rate. If I trust the ratings agency and the default spread that comes with it, I have a default spread of 2.25%. I'm going to take it out. And I want everybody to be clear why I'm taking it out. I want to go to something risk-free. So I'm removing it from the government bond rate. My risk-free rate in Indian rupees in November of 2013 was 6.57%. Now, of course, I also have a Chinese company, Baidu, where I want a renminbi risk-free rate. So basically what I started with is a government bond rate. The default spread for China is much lower. Why? Because its rating is much higher. The default spread is 0.8%. I net it out, I have a risk-free rate. So if you have a currency where there's default risk, you can clean it up, but you have to. You can't just use the government bond rate to come up with the risk-free rate. If you don't like doing this, I'll give you another option. You can just pick a different currency and do your analysis. Currency is a choice. I can analyze any project in any currency. And if I do it right, my answer shouldn't change. For the longest time in Latin America, companies and analysts did all of their analysis in US dollars because they just didn't trust their currency enough. And they said, how the heck am I going to get a risk-free rate I don't know what they're doing in El Salvador now, because you know what El Salvador officially claims as its currency, right? They tried to switch to the Bitcoin. I think it's completely messed up. Nobody can you imagine El Salvador people walking with Bitcoin? I don't think that this is even working. I'm not sure what a risk-free rate in Bitcoin is, so I'll let them figure it out since they made the choice. But you can see why people switch currencies. There's a third choice, which is currency comes into the game because it brings inflation in with it. So when you pick different currencies, they bring different inflations in. And you're going to see this play out on the next chart. There's a third choice, which is do your analysis with no inflation built in into your growth rates, into your cash flows. It's called a real analysis. And basically, you're doing everything in real terms, in which case your risk-free rate has to be a real risk-free rate. And you know what the closest thing to a real risk-free rate we have now in the world is? We heard of the TIPS rate. It's a inflation-protected treasury bond where you can get a rate. It's guaranteed. You get inflation on top of it. You pick your poison. I'll deliver the poison to you. Pick your currency. I'll give you a risk-free rate in that currency. There's no one risk-free rate that I can use based on where you're incorporated. It depends on the currency you pick. Of course, the weakest link in what I just did on the previous page was that default spread, right? I did that dance and said, I'm going to trust the ratings agency. I'm using the ratings agency to get the default spread. And some people don't like it. They don't trust the ratings agency to get it, right? They say, is there a different way of doing it? There are two other ways, though they might not always work for every company. In the case of Brazil, I can give you alternative ways of getting the risk-free rate. Here's the first one. The Brazilian government actually has dollar-denominated bonds that it issues, 10-year dollar-denominated bonds. Let's say the rate on that bond in November of 2013 was 4.25%. So you can buy a 10-year bond issued by the Brazilian government in dollars. You can get 4.25%. On that same day, the T-bond rate in the US was 2.75%. They're both dollar bonds. You don't try to do this. We have different currencies. You can't compare them, but they're the same currency. That difference, 4.25 minus 2.75, is a default spread for Brazil. It's a market set number because markets can overwrite ratings agencies. There's a second way you can get a default spread, and this is something that wasn't accessible or available until about 15 to 20 years ago. There's a market called the sovereign CDS market. Fancy name for a market where you can go buy insurance against default risk by a sovereign. So let's say you buy a Brazilian bond. You're worried about default risk. You can go to the CDS market and buy protection, but buying it will cost you. So let's say you buy the Brazilian bond with a 4.25% rate. You go to the sovereign CDS market, say, I'm terrified of default. They will charge you an amount that every year you have to pay out of your coupon. Think of it as a market set default spread. And in November of 2013, that sovereign CDS spread was 2.5%. So now I have a 1.5% from the government bond market, 2.5% from the sovereign CDS market. And finally, if you don't trust markets, let's say markets have their pluses, they're updated, but the minuses, they tend to bounce around. They can be volatile. You can use the third approach, which is my approach of taking the rating and looking up the default spread that goes to the rating. 1.5%, 2.5%, 2%. You're saying those are very different numbers. They're actually not that very different, but you can say they're different numbers. Which one should I pick? I'm going to say something very odd, but I'll back it up. Pick one of those numbers. But once you pick them, pick that number, I'm going to make you use that number elsewhere. There's another part of this calculation where that default spread is going to come back. So if you pick a low number here, you got to stay with the low number there. And if you're consistent, you're going to be okay, no matter which of these three numbers. But with Brazil, you have all three choices. With India in November of 2013, there are only two choices. India does not issue dollar-denominated bonds. In fact, most countries around the world don't. Asia, it's very unusual to see government bonds in another currency. And there are some countries where all you have is a rating. Much of Africa, there are no government bonds. Yeah, and you don't have a sovereign CDS spread. You're stuck with the rating. There, you have to use the third approach. And there's a small subset of companies where you have none of the three. Take Syria. There is no rating. There's no sovereign CDS spread. There's no government bond. We'll talk about what to do. These are called frontier markets, markets that are so terrifying that nobody even wants to put a number on them. Syria, Sudan, North Korea. You're saying, why would I ever want to invest in North Korea? Who knows? No? They have oiled them. I guess some kind of companies will find a way to get there and invest. So just because a country is Myanmar right now, right? It's a complete mess in terms of country risk, but there are companies still invested there because it's natural resources. So let's look at what the risk-free rates. So using this approach, what I did was I expanded my estimation of risk-free rates in November of 2013 beyond my AAA countries. So these are all the non-AAA rated countries. And what I've done is the column, the overall height of the column is the government bond rate. The purple portion is the default spread. So I'm doing for every government what I did for India, China, and Brazil. And what's left, this ugly green, is my risk-free rate in each of the currencies. Now that, of course, was November 2013. If I update those numbers through January 2022, so I do this every 6 months on my website. I find every government that has a government bond, there are only about 35, and I do the cleaning up just like I did for India. See the blue portion of this graph? Those are my risk-free rates in different currencies. I'm going to make a statement about these risk-free rates that's obvious based on the numbers, but then I'm going to ask you a question, and I think we've kind of answered the question, but if you can put the answer out, we've kind of, I think, cracked the code of currencies. The risk-free rate in Zambian kwacha is much higher than the risk-free rate in Turkish lira, which is much higher than the risk-free rate in Romanian lev, which is much higher than the risk-free rate in Korean won, which is higher. So you can see the risk-free rates vary across currencies. Why do risk-free rates vary across currencies?
Inflation.
Inflation is the only answer. You can't say it's because some governments are riskier, right? Because I've cleaned up for risk. If I've done a good job cleaning up for risk, the only thing left is inflation. High inflation currencies will have high risk-free rates. Low inflation currencies will have low risk-free rates. And deflationary currencies can have what? Negative risk-free rates. So when somebody says, how can risk-free rates turn negative? My answer is, it's unusual, but not unnatural. Risk-free rates will vary across currencies. Through this class, we're going to talk about why currencies don't matter. And the reason they don't matter is that inflation will show up not just in your discount rate, but also in your cash flows. And if you're consistent about currencies, it's going to be offset, right? You pick a high inflation currency like the Zambian kwacha, your discount rate is automatically going to be high because your risk-free rate is almost 25%. But before you freak out, when I do your cash flows as a Zambian company, if you're a company that's not growing, I'm going to see 25% growth because the inflation in the kwacha is so high. So my advice on currencies is pick one and stay consistent, because if you mix and match, terrible things can happen to your analysis because you have different inflation assumptions built in. So don't freak out because usually people say risk-free rates look so low. Okay, they're low, but they are what they are. If I'm doing capital budgeting now, I'm going to use today's risk-free rate. But guess what? When I do my projections for cash flows, I have to be consistent about what kind of expected. I can't build in a 7% expected inflation and leave the risk-free rate at 2%. My analysis is going to blow up. So at least let's get started on the second input. Any questions on risk-free rates by currency? So if you have a currency where there is a government bond, you can clean it up and use it. If you have a currency where you cannot find a government bond rate, don't spend weeks trying to estimate a risk-free rate. Do your analysis in a different currency. Pick euros, dollars, and do everything in that currency. Now let's move to the second input, the risk premium. Let me tell you what we're trying to estimate here. Right now, the T-bond rate in the US is about 2%. It just hit 2%, I think, Friday for the first time in a long time. Say it's 2%. You know what the equity risk premium is? It's what you would demand over and above the 2% for investing in equities as a class. So I'm going to ask you, how much more than 2% would I need to offer you for you to invest in stocks? The answer to that is the equity risk premium. So before we look at the different ways of estimating it, let me lay out some basic propositions. That number should be greater than 0. In hindsight, it can be less than 0, right? Actual returns can be lower, but it's crazy to invest in equities. Danger plus opportunity without demanding a premium. Second, it should depend on how much risk you see in the equity market. You're saying, well, what's the big deal? Won't we all see the same risk? Maybe, maybe not. Will that risk change? Do you feel a little more unsettled now about if you have stocks in your portfolio than 4 weeks ago? I sure do, because there's all this inflation news coming, if there's uncertainty kicking in. So you can already see it depends on how you define average risk in the market, and that can shift depending on the companies you're looking at and how the economy is going. But there's a third factor that really has nothing to do with what's happening out there. It's got to do with what's inside you. It's how risk averse you are. The more risk averse you are, the higher the risk premium you will charge. And risk aversion is something that you're born with. I have 4 kids, they're all grown up now, but I could tell very early in their lifetimes which one of them was going to be invested in bonds for the rest of his life and which one was going to be the option trader. My oldest, until he was 18, when he came down the stairs, would hold on to the banister. Fixed income guy, if you ever saw one, right? I might fall now, I might fall now. And maybe I should have a crutch as well. Can you hold me? My youngest, when he was 2 years old, took off from the top stair, expecting to be caught before he hit the bottom. It's an option trader. I'm saying, don't fight it, right? It's built in. In fact, there's some very interesting research on risk aversion that you might want to think about. If you compare the risk aversion of younger people to older people, there are different ways you can test it, but there are ways to test it. What do you tend to find? Are younger people less risk averse or more risk averse? They're less risk averse. And there's an implication there. There are parts of the world which are aging, right? Japan, Europe. And if this research is true, you know what you should expect to see happen to equity risk premiums in those parts of the world? They're going to go up. Here's a touchier topic. Men versus women. Who's more risk averse? You're saying historically women? Okay. Does anybody want to disagree with that? The research is actually very mixed. Young men are less risk averse than young women. And I can attest it. I have 3 sons and a daughter. And the only one whose car I would get into when they were 20 was my daughter's car. There's no way I would enter, if you think about peak stupidity when it comes to risk aversion, it's probably men around the age of 19, 20, 21. I'm sure you are all the exceptions, but I'm talking generally. But as you age, risk aversion tends to converge. So 35, 40 years old, with one small difference. Men still remain less risk averse on small bets than women. That's why you can explain what happens around Super Bowl. You bet $100, you're a little drunk. Women are thinking $100, that's a lot of money. By the time they make the decision, the game's over. You can't bet anymore. That's the only place where there's difference. But risk aversion tends to converge. And therein lies a very interesting question. You walk into any investment banking's trading floor. Who's disproportionately represented on that floor? Young men. I still remember when it was like 10 years ago, Société Générale, the French bank, had this big trading scandal. Somebody loses $3 billion. And I wrote a post, it's still on my blog, and I said, I have a very simple solution to the trading problem. What's the only check on a young male making bad risk decisions? His mother. I said, here's my suggestion. Hire every trader's mother, pay them a couple of $100,000, it's money well spent, make them sit behind the trader, look over the shoulder, what are you doing? Why are you doing that? That's the only way you check this. But already you can see that if you end up creating groups of people. So I think tech companies have this issue too, right? You go to Silicon Valley, you walk into any young tech company. Not only do you get a set of young males, you get a set of very strange young males, people who stay up at night. I mean, remember, people who write software, the kind of tech people. You're creating risk choices that then show up in how you run your business. So risk aversion matters. And I want you to keep that in mind because I'm going to ask you a question. And there is no right answer to this question. There's actually one wrong answer that I hope none of you pick. But we're going to estimate the risk premium as if this were the entire market. So each of you is an investor. This is the whole market. And I'm asking you a very simple question about what kind of return you would need to make to switch your money from where it is right now, where it makes, let's say, 3% guaranteed into equities. And let's be specific. Let's suppose the equities, I give it a name, the Vanguard 500 index funds. You know exactly what you're investing in, the S&P 500. So you ready? You're making 3% guaranteed. I'm asking you about the expected return you would need to make on this Vanguard 500 fund to switch. How many would accept less than 3%? Thank God for small blessings. If all of you had put up your hand and said, let's disband the class right now, we are beyond redemption. Nothing we do in this class can save you. And you can see why, right? If you can make 3% guaranteed, it's kind of not just, it's crazy to accept an expected return less than 3%. How many of you would accept a return between 3 and 5%? Are these the most risk-averse people in the room or the least risk-averse people in the room? They're the least risk-averse people in the room. Nothing wrong with that, but this is what I would anticipate. I would anticipate that when you get your job and you get that 401k and they ask you, where should you invest your money? You're going to be entirely in equities, perhaps the riskiest of the choices they give you. And if you ever marry somebody, make sure that you check out their risk aversion before you marry them, because you know, one of the classic mismatches you end up with is you pick somebody who's less risk averse, somebody who's incredibly risk averse, you put them together in a relationship. Now, either one of you just has to be completely in denial about financials and not look at it. You're going to have every fight in the face of it coming from differences in risk aversion. But when you say between 3 and 5%, you've given away your equity risk premium, right? So let's take the upper end of that scale. At 5%, your equity risk premium is roughly 2%. How many of you do 5 to 7? Okay. 7 to 9? So it looks like the 5 to 7 and the 7 to 9 are the heart of the distribution. That's about a risk premium of 4 or 5%. How many would ask for 9 to 11? Okay. Anybody more than 11? 9 to 11 is the most risk-averse person in the room. Historically, where are you from? Are you from the US or are you from somewhere else?
Yeah, I'm from Pittsburgh.
Pittsburgh, okay. That might explain your risk aversion because Pittsburgh can make you more risk averse. But the reason I said that is often when I ask this question, when I get to the upper end of the distribution, you get a lot of emerging market people pick that because you know how you learn about risk through harsh experience, right? You've seen this happen, you know what it means. But here's the bottom line. This is a pretty homogeneous group, right? In terms of age, in terms of where you are in your careers. And think of how different the risk premiums were. If this were the entire market, you know what I should be using at the equity risk premium? The weighted average, because in a sense, I've extracted each of your risk premiums. I should take a weighted average. Weighted by what? Not by how much enthusiasm you showed when you put up your hand. Let me be brutally honest. If you have no money, I don't care what your risk premium is. If you have lots of money, I care a lot. This is a weighted average. The weights are based on how much money you bring to the market. Have you ever wondered why people are in tenterhooks every time Warren Buffett says something about stocks? When you have $40 billion to bring to the market, your words have a much bigger weight than somebody with $40,000 saying it. So here's the challenge we face. I mean, I kept the market to this room, but if you open up the market to who's really out there, you have tens of millions of people, each of whom have very different risk aversions and different premiums. And I'll add to the challenge, even if I could ask this question of every single investor, I have a follow-up problem. The number will keep shifting. Let me explain. I just asked you a question. You gave me the answer, right? 2%, 4%. Let's suppose while you were sitting here this morning, don't freak out, I'm just making this up. The market dropped 25%. It's been a collapse in the market. And then I asked you the question I asked you before. How much of a premium would you demand over? How many of you now demand a larger premium? And you can see that sometimes a reminder that things are scary is a reminder about risk. How many of you demand a smaller premium? And your rationale would be?
I guess 5 to 10.
It's contrarian, right? If stocks were good 15 minutes ago at 30,000, now they're down 25%. It's a classic contrarian strategy. And I'll give you the good news. If you look at research, contrarian strategies tend to beat out momentum strategies, but they come with one big catch. It's easy in the abstract to say, I'll buy stocks on a dip. I still remember in March of 2020, there were stocks I wanted to buy, how difficult it was psychologically to hit the buy button when everybody's selling. A lot of contrarians are contrarians on paper, but they can't be contrarians in practice. I'm not saying that about you, but I'm saying, but the reality is risk premiums can change. They can go up, they can go down, and they do it all the time. So let me make a statement. Risk premiums are a number that reflects a market, but they're dynamic. They can go up, they can go down. And when we estimate risk premiums, we want to come up with a way of doing it that reflects that risk premiums can change over time. Stating the obvious, might as well put on the. So I'm going to give you the 3 ways in which you can estimate equity risk premiums. I'll give you my preferences because I'm not going to give you on the one hand and the other hand. The first and the least used way of getting equity risk premiums is to do what I just did, do a survey. You ask portfolio managers, what do you think stocks will do? You ask analysts, what do you think stocks will do? And you estimate a premium. It's called a survey premium. I'll talk about what the numbers look like and why nobody uses them. The second is to look backwards. You know what I mean by looking backwards? When I ask you what will stocks do in the future, you look at what have stocks done in the past. How much more than the T-bond rate could I have made? And when you do that, what are you implicitly assuming? What's called mean reversion, that things always revert back to the norm. Not a bad assumption, right? Markets are known for mean reversion. And the problem though is when you look backwards, the number is static. What I mean by that is you started the year with a risk premium for the last 75 years. Guess what? Nothing that happens in the first 2 weeks of this year can change that number much because it's so sticky. So I'm going to give you a third approach, which is forward-looking rather than backward-looking and dynamic. It's called an implied premium. So let's start with the first of these 3, the survey approach. Now, when you think about running a survey, you can't survey everybody. There are too many people. So almost every survey approach picks a group of people to survey. Each has its own rationale for why they pick the group. One is there used to be a group called the Securities Industries Association, a kind of trade group that used to survey individual investors. They stopped doing it in 2004 because they discovered very quickly that what these premiums were reflections of the past. In other words, you surveyed investors after a good year, you got a really high number. For a bad year, so basically the investors were telling you what happened last year rather than expectations. So they dismissed individual investors as being too stupid and too backward looking. Merrill Lynch has been serving institutional investors now for decades. That number, if you look at 2013, was about 4.8%. So they look at big mutual fund managers. They ask them a question, what will stocks do? But the limits of that survey is portfolio managers will answer that question if you ask them for a 1-year period, but if you ask them for 5 years, it's too uncertain. So these are very short-term premiums, again, very sticky, reflecting the past. So it looks like institutional investors and individual investors like that. Campbell Harvey and John Graham at Duke actually do a very interesting survey. Rather than ask investors, they ask CFOs. You know why CFOs use risk premiums? Because these are the premiums used to build up costs of equity and hurdle rates in companies. You get a very different perspective, much stickier, because companies don't like to change their hurdle rates very much. And I think the most recent one, if I can find it, was from 2019. I'll send you that number. It's like 3.5 to 4%. Doesn't move very much. And that might be a problem because it's so sticky. Pablo Hernandez, who teaches in Spain, does a survey of analysts who value companies. Very different group, right? They value, and he actually does it by country and breaks it down. And their premiums, and there's an updated version of this as well, which I can send you, reflect what analysts are using there. And finally, perhaps the most useless survey of all, Pablo also surveys academics. You know why, right? What did I say your premium is? A weighted average. Weighted by what? How much money you bring to the market. I don't know why he's even wasting his time asking but I guess academics use these premiums in classrooms, they get carried to the analysts, so, kind of the residual effect. So my point is you have different groups and they get different numbers, and numbers can change over time or not change over time. And the reason nobody uses them is they don't tell you much about the future. They all seem to be reflections of the past. And sometimes, especially with individual investors, you don't get expectations, you get hopes. You know what I mean by hopes? You ask somebody, what do stocks do? 25%. Why? Because I need to make 25% to pay my student loan. Okay, that's not a good basis for forming expectations. But in a survey, you can say whatever you want, right? There's no boundedness on what's high, what's low. You're just making up a number. So let me at least start on the historical premium approach, because this is the default that most banks, most consulting firms, most companies use. They look backwards. They look at the last 20 years, the last 50 years. They look at the average return you'd have made on stocks over that period. Let's say it's 7%. They look at the average return you'd have made on T-bonds over the period, 3%. 7 minus 3 is 4. That's a historical risk premium. Doesn't sound unreasonable, right? But before I show you what the numbers look like at the start of 2022, when you use a historical risk premium, you're assuming not just mean reversion, but that the structure of the economy has changed. Risk hasn't changed, that you revert. Now, pre-2008, I used to have much more patience for people using historical risk premiums, especially in the US, because the US was the most mean reverting, predictable economy of the 20th century. You're saying what happened in 2008? You should never ask that question, because everybody knows that 2008 was a breaking point. It's a breaking point in how much we trusted institutions, a breaking point in whether banks were well regulated. And it was a breaking point in the global economy. Finally, I mean, for some people, this took a while, the recognition that the global economy was not just the US economy driving everything, that it was truly a global economy. You know what I'm saying, right? The structural model has changed. And my problem with historical risk premiums is even if they're precise, they reflect the past and they might not reflect the world we live in. So here's the final page, and then we'll start on this page, so I'll talk a little bit more about this. At the start of every year on my website, I update historical risk premiums for the US. Notice the word I use, premiums. You're saying, why are there multiple premiums? Because it depends on what slice of history I look at. I get very different premiums. It depends on whether I look at T-bills or T-bonds, short-term or long-term. It even depends on how I compute my average. I can do an arithmetic average, take 80 years, add them up, divide by 80, or I can do a compounded average. So next class when we start, on next Wednesday, I'm going to talk about why the numbers are so different, and then what these red numbers are, because those red numbers to me are danger signs anytime you use a historical risk premium. But we'll start with that next class. So have a good long weekend, and I will see you next Wednesday online on Zoom, not in here, right?